I think it's going to be more of an alpha-driven market, to use the fancy word, of stock picking. And it's going to be about, in that era of no longer have cheap energy, no longer have cheap goods, no longer have cheap labor. We're going to have to figure out which companies can survive in that environment better than other companies.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with macro researcher Jim Bianco. If you haven't yet watched part 1 of this discussion with Jim, in which he details everything he currently knows about the unfolding implosion of major crypto exchange FTX and all of its absolutely bonkers developments, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Jim also kindly shares several of the assets that he thinks will best weather the coming storm, so be sure to stick around to hear those. Okay, let's get started watching part 2 of our interview with Jim Bianco. All right, so you talked about how you think CPI has peaked, so an interpretation of that is we are now heading into disinflation going forward. You've said that you think it's going to take a while to really wrestle inflation down. I guess let's just start from your macro outlook, looking at just sort of economic growth. What do you see as sort of the growth prospects from here as the Fed is having this wrestling match with inflation? It's continuing to hike. It's told us it's going to hike more. It's told us it's going to hang out and not pivot. All of that is depressive of growth.
Right. So the first 2 quarters, GDP was negative. And I've been on record to say that I think that we had a recession or are having a recession. And I've also been clear that it is an extraordinarily mild recession, but a recession nevertheless. Third quarter, we saw a pickup. We might even see another little bit pickup in the fourth quarter as well. So let's start with that growth has not been good at all this year. Earnings are down to about a 4% year over year growth rate right now, earnings. By the way, that's nominal earnings. So in an 8% inflation world and you have 4% earnings, that means on a real basis, you're negative 4%. You're not even keeping pace with inflation. So earnings have been struggling. The economy has been struggling as inflation has been going up. Now, the Fed has been raising rates aggressively. I'll give Paul his due. I think he said this correctly. 40% of the public owns no financial assets. They don't have a brokerage statement. They don't own a home. They rent, and they just live on their paycheck or their disability or their unemployment insurance or their Social Security or whatever welfare they might get or whatever they get, either a government transfer or a paycheck. Inflation kills them. It absolutely kills them because they don't have any prospects of owning something that could appreciate in value because they don't own anything. And so Paul has pointed out these people are the biggest losers when it comes to inflation. He is 100% correct. Mm-hmm. And that this is why inflation is not only is it bad for everybody, you, me, Elon Musk feels inflation too, but it devastates these people. So I'm with him. Do not underestimate the impact that high inflation is having on the economy. It is devastating. So he's raising rates aggressively and he wants to rein in inflation. And he keeps making this comment that he's going to continue doing this until we get back to 2%. Well, Wall Street's got this fixation that in March, when we get 9% year over year and 9.1% year over year CPI, that was the peak. Well, it was probably the peak. As I like to say, if you're going to tell me we're going to hang out at 7 or 8% inflation for another year or two, it will be devastating for financial markets. So I don't think that saying that inflation is peaked is a wild statement, nor a statement that should elicit a giant move in markets. And they did, and I'll tell you why I think in a second. I think the better answer is, where are we going? Are we going all the way back to 2 on inflation, which was the Fed's original target pre-pandemic? We're going to stop somewhere higher. And I think we're going to stop somewhere higher, like around 3.5 or 4. And I've argued that in the post-pandemic world, that we've had a number of secular changes, the end of cheap labor, the end of cheap goods and the end of cheap energy. And that's why inflation is going to go higher. Demographics and technology still exist to help hold inflation down, but those three are too big for demographics and technology to overcome. So we're going to have higher inflation. Now, Wall Street, let me mention something about Wall Street. We could, in our discussion of cryptos, what the message there was, it was this out of control casino that was, pump and dump and everything else. Well, same thing's going on in Wall Street. If you didn't notice, go look at what the options market did last week. It set new records in volume. It set new records in turnover. And by the way, the old records were the week that GameStop blew up in January of 21. We have now seen more wild speculation in the U.S. listed options in S&P 500 markets than we did that week.
Wow.
We have seen wild speculation. Look at what happened on Thursday and Friday with the unprofitable tech index. Goldman Sachs has an unprofitable tech index. That's all the Zooms and the Pelotons of the world and stuff, up 25% in 2 days, Thursday
Isn't that crazy?
and Friday. Yes. So before we cast stones to the crypto market going, you guys are an out of control casino, we're not that far behind them in some of the stuff that we're doing in the current market right now. And so whenever something positive happens, and I'll use a crypto term, the degens, which is short for degenerate gamblers, the degens jump into the options market and they go crazy, and these markets have these ridiculously outsized moves, up 5.5% on Thursday last week from when we're recording in one day, follow through with an update on Friday, and at least we're unchanged as we're talking here today. So these gigantic moves, the biggest moves in 2 years that we've seen in these markets. So yes, inflation has peaked and it's coming down. The question is whether or not it goes to 4%. And the answer is no, inflation's peaked. Buy every crappy company out there. Carvana, which even the bulls will tell you probably has an upside, has a valuation of 0 and should be liquidated, was up 30% on Thursday. So this is the kind of wild, does this remind you of like March, April of 2021 when we were buying Avis in bankruptcy and they
Hertz,
wanted to issue stock, or Hertz, excuse me. They wanted, apologies to Avis. They were buying Hertz in bankruptcy and the stock was rallying and they wanted to issue new stock while they were still in bankruptcy to fund themselves. and a bankruptcy judge had to say, time out here. You can't do that in bankruptcy. And the reason is that no company's stock goes up 1,000% while in bankruptcy because there's supposed to be no value for that company. Well, that kind of crazy, I'll use a technical term here, that kind of crazy shit is happening all over again right now. And that's why when you see this idea that inflation has peaked and it's starting down, everybody starts saying, that's it, the Fed's done. They're going to raise rates in December. They're done. They're going to start cutting rates. The economy's going to hit the skids. Everything's going to be bad. Oh, well, should I own stocks? Yes, because he's going to cut rates back to 0 and print money and the stock market will go to 5,000 on the S&P. And I was like, well, how's that supposed to work? So the worse everything gets, the higher the stock market goes. Yes, because bad news is good news. And that's the upside world that we're in right now. Hopefully that makes sense.
No, it does. I appreciate you jumping on that soapbox. It's one that I and several of our guests have been on here. Just talked with Lance Roberts over the weekend, who showed a chart of how past Fed pivots, and that's all the market cares about, right? It's the pivot, right? Oh, they're going to bring rates down again.
It's a junkie. The market is a junkie, and their drug is cheap money. And they want their pusher, Jay Powell, to give them an injection, if you want to think about it in those terms.
That's a great analogy. And in the past, at least, looking at past Fed pivots, they haven't resulted in an immediate sugar rush in the market. In bear markets where the Fed has actually shifted policy, it's been months to quarters afterwards when the market finally found its bottom, right? So the market,
I know the chart you're talking about. Lance does great work. And it's very simple. In the past, when does the Fed pivot? When they panic because the economy hit a brick wall and it's bad. And then they pivot and the market Does the market rally because they're pivoting? No, it's panicking because everything's falling apart.
Everything's so damn bad. Yeah, exactly.
Right. And now all of a sudden we want the Fed to pivot, but doesn't that mean that things are going bad when they pivot? No, this is going to be the good pivot or something like this. Is kind of the logic that we're trying to employ right now.
Right. So I think we've got two big questions, right? One is market's totally expecting the Fed to pivot, and it's looking for any excuse to say, yes, now we've got the evidence that he's going to do it, right?
Right.
And the question number one is the Fed going to pivot? Because of course, if you listen to Powell, at least, and I understand why people are skeptical of the Fed, but if you listen to Powell, he's taking incredible pains to say, folks, pivot ain't happening. I'm gonna keep raising in the near term, and then I'm gonna pause and I'm gonna hold out there for a long time. So he's basically
And
saying
might have to start raising again, if inflation doesn't come down.
right. If it doesn't, yeah. And then the second one is, let's say he does pivot. Then the question is the pivot effect going to be what the market is anticipating? And I think you just made a good case that, it probably won't be. If the Fed is forced to pivot under, this particular set of circumstances, it's probably going to be because some god awful things are happening, and we're all going to be freaking out and seeking, shelter at that point. We're not going to be looking to roll our dice and buy meme stocks.
Well, let me take the second point first. What they're hoping for on that Fed pivot is kind of what we had going about a month ago. British pensions blew up because of their mini budget and stuff,
right?
And interest rates in the UK soared, and people were like, almost like the reaction in the market was, oh, good. It's something that doesn't bother me. I'm not British. I don't have a British pension. Neither do you. And it'll get the Fed to stop. So we win.
Right.
No, it doesn't work that way. It's not something that happens to somebody else that the result is your portfolio goes up a zillion percent. It's something that happens to you is what gets the Fed is what gets the Fed to pivot. So yeah, that's the good pivot scenario that everybody is hoping for. But you're right. Will the Fed pivot? Here's the problem. Jay Powell has made it very clear that tightening financial conditions is a key ingredient in bringing down inflation. That's a euphemism for you and me and everybody listening to us. We all lose a lot of money and we have glum faces and we stop spending or spend less. And then therefore it reduces demand and brings down inflation. So if the market is going to celebrate and rally, this is what he talked about in August when he gave the 8-minute speech at Jackson Hole. There is going to be no pivot because he needs financial markets to stay down to create a reverse wealth effect. Now, where the confusion, I think, is coming in is there's a number of members of the FOMC that are not in agreement with Jay Powell.
Mm-hmm.
And they don't say it directly. Lael Brainerd.
Yeah, they play it coy.
What's that?
They play it coy.
Right. Lael Brainerd, big MMT believer. Charlie Evans of the Chicago Fed, Mary Daly of the San Francisco Fed. They're of the opinion that if you were to ask them truthfully, the Fed's gone way too far and it's not necessary. And inflation is not a problem. This is a artifact of reopening the economy. It's going to peak. It's going to go down to 2% by itself. We don't need to be that aggressive. On the other side, you've got Chris Waller, a Fed governor, or Jim Bullard of the St. Louis Fed, who are thinking more along the lines of Jay Powell, that inflation is persistent and it's a problem and it hurts those 40% and we have to be aggressive in bringing it down. The difference, though, is so this confusion is what gets Wall Street to hope every time. But what everybody forgets is the chairman gets what the chairman wants. If Lael Brainerd thinks it's a mistake, if Mary Daly thinks it's a mistake, if Charlie Evans thinks it's a mistake, duly noted, we're raising rates 75 at the next meeting. Any questions? And that's the way it's been for the last 4 or 5 months.
It's not a democracy. Yeah.
Right, exactly. And I might add, you've probably seen Wall Street do these hawk-dove meters. Who's the most dovish to who's the most hawkish? I think the most hawkish member of the Fed right now might very well be Jay Powell. And, he's channeling his inner Volcker and doesn't want to be Arthur Burns and all of this other stuff, and that he wants to get this inflation thing reined in. So, yeah, this is not a democracy. The way the Fed works is you have to agree with me in the meeting, but you could schedule a meeting, come in my office and jump up and down and stammer your feet and say, no, you've got the wrong policy. And I'll look at you with an empathetic face and pretend like I'm listening to you. And when you're done, we're good. And when you're done, we're going to do exactly what I want to do. That's the way that the Fed works. And so it's all about what Jay wants. And from every indication is he wants to keep financial conditions tight. And he wants to see evidence, not that inflation is going down, but it's going to 2%. And we have no evidence at all that it's going to 2% right now. So I think they're going to raise rates 50 basis points at the next meeting. People are misunderstanding that. We'll be at 4.5 at that point at the next meeting. We'd be 250 basis point moves away from practically 6% if that's what they wanted. So they're, and 50, when did 50 become the equivalent of an ease? 6 months ago, that was a disaster if the Fed was going to move. I mean, now all of a sudden a 50 basis point hike is an ease. I mean, as far as the market is trying to interpret this. So again, this is all about this idea for 20 years, everybody in the market has been conditioned to the Fed drops, the Fed prints, everything goes up. Buy a broad-based ETF on leverage, you'll win. That mentality is so ingrained in the market, as I mentioned before. Now we've got this out-of-control options trading. By the way, here's another fun fact for you about options trading. Every week, the options exchanges issue options that expire the next week. So last Friday, they issued a bunch of new options that expired this Friday. That's almost half the trading now on the options markets.
You're kidding me.
Is options that expire in less than a week. And so and you want to know what it is? So it's all, look, last week we had the $2 billion lottery. We have that every minute on Wall Street in the options market. Everybody's buying these options that expire in 2 days, and they're buying out of the money options, and they're paying 1 cent for them. And they're hoping for something like Thursday. Market goes up, and then my 1 cent option becomes worth 6 cents. And I made 6x my money. Well, they won on Thursday. But you know what 90% of those options wind up doing? 90% expire worthless. You lose all your money over and over and over and over and over again. And then one time you make 6x on your money. But if you looked at the grand mosaic of what you've been trying to do with all this wild option speculation, you've probably been getting crushed.
You're right. And the only people who really benefit long run are the casinos, the exchanges that are selling these options.
And then what they do is they go to Twitter and then they whine and complain. It's all Jay Powell's fault because he won't cut interest rates. It's not my fault for engaged in stupid speculation.
All right. So
other than that, I've got no opinion on this subject.
All right. Well, look, so I'm going to get to markets in a second, but so it seems that you are skeptical of the rally that just fired off last week.
Skeptical in respect that is the bear market over? I don't see evidence of it. I do see, but yes, no, look, this rally could go to the end of the year. It could go another 6 weeks. It could end later this week. But is it the sign that the market is turned? I tweeted out something today that I think is perfect, that fits into this mentality perfectly. The DAX, which is the German stock market, rallied 20% off its September low. And Bloomberg had this big red headline. I'm looking at my Bloomberg right now. DAX up 20% in a new bull market. And I looked at it and I said, okay, if you start the year, well, in January 1st, the German stock market started in a bull market. Then it fell 20% into March. Then it rose 20% exactly, into May. Then it fell 23% into September, and then it rose 21%. And I said, here's the problem with all these dumb definitions. We've had 3 bull markets and 2 bear markets in calendar year 2022. So we're on bull market number 3 in November for the year. And don't worry, there'll be another one after this and another one after this. And my point is, can the stock market rally 15% or 20% off the low? Sure, it almost did it in in June. It rallied from the June to August high 17% before it turned around and made a lower low. It could do something like that again now. But is this mean that this is it, that October 10th at 3,400 on the S&P was the low? Sure, it could be, but I'm not sure yet. So I'm not willing to say that's it, it's all over with. Get into stocks We're on our way back to 4,800 for the first stop and a much higher move in the stock market. The problem with bear markets is they come with extraordinary volatility. Another fun fact for you, the market was up 5.5%. The S&P was on last Thursday. If you look at the standard definitions of bull markets, in the history of the market, we've never had a rally, a one-day rally in a bull market of more than 4%. Yet we had a 5.5% rally last week. That's because big, huge moves like this are always accompanied in a bear market. They said this is the hallmark of what a bear market does.
Right.
Is it, it is, oh, a bear market's easy, right? I just short the market. It's impossible because you get these kind of hellacious moves against you all the time, and it makes it impossible to short, and people that are long don't like it. Everybody's frustrated in a bear market.
Right. And they tend to, those violent rallies tend to sucker all the people who've been on the sidelines back in just to pull the rug out from under them again, too. That's why bear markets are so destructive.
Right. Because I like to joke that what are most of these options traders, when they stare at the ceiling at night, worried about? Are they worried that they're buying more options that are going to expire worthless? No, they're worried that this market's going to zoom up 30 or 40% next year, and that they're not going to be in double levered, triple levered S&Ps when it goes up 30 or 40. That's what they're most worried about. Not, hey, will the trapdoor open on this market because there's too much speculation and too much inflation, and the financial system is too offsides, and just an extreme example of that is crypto. No, they don't worry about that. They worry about it going back to 5,000 without them playing on it in double levered form. That's where I think we are. And that's what's got me very worried about looking at the structure of the market right now. There's no capitulation in this market here. And we'll have to see whether or not we wind up getting that later on.
All right. I want to build on that real quick. Two things. First, one is I just got to, again, heap more blame on the Fed here, because they created not only all the inflation that we're massively involved in creating all the inflation that we're dealing with here. Yes, there were some other factors, but at the end of the day, the Fed, set all the foundation for it all. But they have spent the past 12 years training the market. Don't fight the Fed. We'll come in and rescue at any moment in time. And it's so funny now that they're having trouble wrestling the monster they created because the market now wants to fight the Fed. They're just not believing that the Fed has actually changed its spots here, right? And the Fed is trying to tell everybody, hey, I'm now different than, the game has changed, and the market's just saying, nope, we don't believe you, right?
That's why I know sometimes I feel that way too, that, I'm always bashing the Fed, but then I always have to sit back and go, this is a monster they created. They created this monster after 15 years of money printing, and they underscored it with COVID. And they don't really get a handle on the OECD, the Organization of Economic Cooperation and Development, looked at all of the 30 developed countries of the world. And they found that during the lockdowns of 2020, only one country had personal income rise. Personal income is your paycheck plus whatever investments you have, plus whatever government transfers you get. It was the United States. Why? Because everybody lost their job, the economy fell, and what did we do? We mailed everybody money. You wind up becoming your financial position improved because we locked the economy down.
Right.
And the mentality that was taken away from that is, I'm bulletproof. I'm bulletproof, man. When things go bad, go to the mailbox. There'll be money in the mailbox. And when things go good, my brokerage account goes up. And that's the mentality they helped to create. And that's what they're fighting against right now.
All right.
I know it's disappointing, but we got to call it what it is.
And it's nothing we haven't covered, but to hear you just explain it so succinctly, it is a little bit of more than a little bit of a
disappointing. It is disappointing because we all know that this ends badly, and inflation might be the early signs of that happening. It's not too early to that, prudent policies. I think Powell is trying, but the problem is that now he's got, he's getting mean letters from Elizabeth Warren about, unemployment and the rest. But, it's not a good situation. Again, it's not like I'm going to, give Paul a total pass. He's basically an arsonist that's got morals right now.
Right.
Okay,
Yeah,
I'm tired of lighting buildings on fire. Let me start putting some of them out. Yeah, but you still lit some on fire. So
right. He's an
we're not
arsonist
going to
who had
forget
to
that.
change a heart. Yeah.
Yeah.
Yeah. Whatever. I
I left you speechless.
yeah. I had something brilliant to say on top of that, but it's out of my brain here. Okay. And that's what it was, which is just, look, once you deform the system by as much as they have for as long as they have, and I'm not just putting it on the Fed, it's Congress has been complicit as well, and whatnot.
Right.
And all the abuses that have happened in Wall Street by all the people who've just been taking advantage of what's been going on. You pass a point, which we passed a long time ago, where you can resolve things without pain, right? And so to your point, Jim, guys like you and I, we kind of root for taking our lumps. We root for the reckoning only because we know that keeping it going and deforming it even more is just going to make the eventual inevitable reckoning even worse down the road, right? And you feel terrible saying, look, I'm rooting for reform or for changes or collapse, even correction to a certain extent, that we know is going to be painful for an awful lot of people. But we're doing
us
it
too.
Pardon me?
And maybe us too.
And maybe us too. But we are rooting for that because we know if we don't do it now, it's going to be way worse later on for everybody else, right? But it's just a hard place to be in, right?
Right. And exactly. And I think that, part of that is also an understanding that I have, maybe you have too, from being in the markets for a long time. The markets are a never ending game. And I tend to think that a lot of these people that are playing this game now with all the options and stuff like that, they always, some of their mentality, if you go to the Reddit boards, and I do from time to time and read what they're saying, this is my one chance, YOLO, is what, you only live once. No, the markets have infinite amounts of chances. If I blow this one, there's another one. And there's another one after that, and another one after that. But what I do want is sane, rational markets that help to expand the pie for everybody else and not just turn into this useless casino. And that's what I'd like to see happen. And if that adjustment period creates some setback or creates some hardship, we'll get past it. And then there'll be opportunities on the other side. There always is. But if you want to approach this like a lot of people approach this, if I miss that move to 5,000 when the Fed stops raising rates and I'm not double levered long, that's it, my life's over. Why? There'll be another move after that, another move after that. And they don't view it that way. They got such a short-termism type of viewpoint. I have to win now in this bet right here. And so that's why you've got this mentality that no one wants to ever take any pain, because they are always so afraid that if they wind up taking any kind of pain, that it's going to become devastating for them. No, it won't. You'll get past it. The markets will adjust and recover, and hopefully they'll move along at a saner clip. And what I mean by a saner clip is it's not just financial markets go up and the wealthy that happen to own financial assets, you, me, everybody listening to us. It's also that people in the 40% get better affordability, get better jobs, and can see their paycheck meet their needs by not being consumed by inflation. So right. That it's a win for everybody. Then we're off sides now. We got to get back on sides. And if it wasn't painful, if we could do that with no pain, we would have done that years ago. But that's the problem. No one wants to take the pain, so we always no, and we just keep making it worse.
Well, totally agree, and that's why I want to get into the pain topic for a second, and then we'll conclude with sort of your views on what assets do you think are either attractive right now or worrisome right now given the current lay of the land. So Powell, to his credit, has said, hey, you got to businesses, households, we're going to have to take some pain to get through this thing, right? Getting inflation down is going to require we take on pain, which I'm actually amazed that a Fed sitting Fed chair is actually willing to say that. But
And I'm more amazed that the market isn't listening to him.
And we just talked about that, though. It's this monster that the Fed has, created.
Yeah, exactly. If you would have told me or you 2 years ago, someday the Fed's going to say we have to have pain and raise interest rates or watch the unemployment rate go up, and the market would have said, "Yeah, buy stocks." He doesn't mean it. That's kind of where we're at right now.
It is. So the Fed is hiking. As we've talked about, they've hiked very aggressively. They're going to continue hiking. They're going to hold likely and not pivot. Rates have risen at the fastest rate in the history of the data set here, which I've talked about in this program many times. Is going to sort of send the economy into a shock, the way that if you drop somebody into Arctic waters, it's yes, they get cold, but it's the fast pace at which they get cold is what sends their system into immediate shock, right?
Right.
And we have so much more debt in the system this time, right? 31 trillion just of federal debt alone versus, what was it? 9 trillion going into 2008, something like that.
Yes. And
so almost 2.5
now,
times more.
Yeah. And more of it now is that federal debt as a percentage of all debt is higher now than it was 2008. One of the things coming out of 2008 was the private sector delevered, but the public sector took on more debt. So it's more government debt than it was private sector debt as a percentage of the whole. Got it.
Yeah. Although a lot of corporate America has been adding a lot of debt back on, especially to do things like, well, one, you get the zombie companies out there that are just doing it to stay alive, but then you've had companies funding stock buybacks with super cheap debt, which is now no longer super cheap, right?
Right.
So the question it raises is, for the folks that are rooting for the pivot, is, oh, something's going to break and it's going to force Powell to pivot here. I guess my question for you is do you see going into next year big knock-on effects from this higher cost of capital that we suddenly now have?
To start there, yeah, I probably do. As I've always said, the bond market is too big, too complicated, and too opaque for me or Jamie Dimon or anybody in between to tell you that here's what's going to break. I don't know what's going to break, but I can look at the losses in the bond market. The total return losses this year are an all-time record. Bank of America has a new chart out that says the last time the bond market saw losses similar to this was 1920, 102 years ago. So it's the worst bond market in 100 years. The MOVE index, which is the Merrill Options Volatility Estimate, which is the VIX of the bond market, one of the highest measures that we've ever seen. Liquidity measures in the bond market are back to 2008-9 levels. So I don't know what's going to break, but when I see the losses in the bond market this big, the volatility this high, and the liquidity this bad, it doesn't take a rocket scientist to say somebody's being pressed, and somewhere on the next move up in interest rates, there'll probably always be a move up in interest rates, something will break. The old adage you've probably heard is the Fed keeps raising until something breaks. Well, yesterday, Chris Waller gave a speech in Sydney, Australia, and he crowed in the speech, well, we've raised rates and nothing's broken. And I was like, don't say that, Chris, because what I'm hearing you say is we're just going to keep going until something does.
Yep.
And, you're not going to be able to figure out that we're going to get everybody on the ledge, and before somebody gets pushed over, we're going to pull them all back. So yes, I do think something's going to break. What? I can't tell you, but I don't think anybody can. No one could have told us 2 months ago that the British pension plan with liability-driven investing was on the verge of going over the side. And yet it was, and it did. And so, and even those that are most acutely involved in that didn't see that as being the issue. But there will be something. There always is.
Okay. So we've got systemic risk, and I'm not trying to put words in your mouth, but we'll call it material systemic risk building.
Yes.
And then just recession real quick. You talked about how we've, in your eyes, already had a mild recession this year. But as we head into next year with the deceleration in growth that we talked about earlier, and potentially even a black swan of systemic risk out here, do you expect there to be a recession next year? And if so, what magnitude do you expect?
Yeah, I do. If we do continue to see signs, at least in the near term, let's start in the near term. The signs of a recession are hard to see right now. 261,000 jobs. Initial claims are still, fairly low at around 225,000. These are metrics that we look and say, is the labor market in trouble? No, not really. Earnings, as I said earlier, they're growing at a 4% pace, but it's not the inflation rate. Okay, but they're growing. They're not contracting at a 20 or 30% pace, is what they often do in a recession. So is earnings a disaster? No. Housing, there's your one weak point that you've got right now. Housing is a big problem. But when asked about this at his press conference a couple of weeks ago, Jay Powell dismissed housing. Oh, but home prices were up a lot in 2021. So we've given back some of your big gains, but you're still net ahead of where you were 2 years ago. He doesn't seem to be concerned about it. So yeah, when you add it up, I don't see the signs that a recession is there right now. But I think the Fed's going to conclude so we can keep going. And then eventually some of this stuff will turn south. And then we will see the problems that will metastasize from a recession. And then the big question will become, when we have a recession. And by the way, just as a quick aside, one of the things that I find it's very amazing about this period too is that you'll get big brokerage houses and big money managers that just matter-of-factly say, oh yeah, our forecast is for a recession next year, as if it's a statement of fact, where in previous years, if you had big, giant, multi-billion-dollar banks or brokerage houses having economists run around saying, no, next year we'll have a recession, they got fired because they were going to panic everybody. But
Right.
now it's almost like it's okay to say it. What is implied in that statement is when we get that recession, but then the inflation rate will plummet down to 2 or 1%, and that will allow the Fed to cut rates like crazy.
Fed will come in.
They'll print the balance sheet. But the real question is going to be stagflation. What happens if we get that recession and you look over and go, but the inflation rate's still at 4 or 3.5. It's not on its way to 1 or 0, so that the Fed could go back to the way it was in 2018 or 2019 or 2017. And that is really, I think that the surprise will be that inflation will stay sticky in that recession. And that when everybody says, good, we're in a recession, now if Jay can cut and the stock market can go up, he'll go, hold on a minute, we have too much inflation. I can't really start cutting right now. And that'll be the big problem we'll face when we get that downturn.
So we'll have sort of the worst of both worlds there, right?
Yeah,
You'll still be getting squeezed to the cut.
Right. And we don't have it now except in housing. So for those that I keep hearing say, oh, the Fed's going to raise rates again in December and then they're done. Why? Why are they going to do that? There's no data that suggests it's bad. Well, housing is bad. But Jay just told us he's not concerned about that. He said, your home went up a lot in 20 and 21. So it gave back a little bit in 22. You're fine. Next question. That's the kind of the way that he seems to be dismissing the housing problems right now. Maybe that's a mistake. Very well could be a mistake. But the point is that bad housing data is not going to get him to change his mind about raising rates.
Yeah. And my point is, we can have the argument that, okay, both jobs and housing data those are lagging indicators. I think Powell may even be deliberately leaning hard on lagging indicators that he probably knows are rosier than the reality on the ground today for folks. Because I think to a certain extent, this is my opinion, that, Powell knows that the Fed created these asset bubbles. And at the end of the day, it realized they're getting out of control. They're not helpful. And so inflation is giving him the excuse to take the air out of some of these asset bubbles and maybe help with wealth disparity a little bit. But regardless of what happens here, I look at the data and just think, okay, look, housing's going to have to roll over further from here, right? It's just mathematically with the jump we've had in mortgage rates, we haven't seen a commensurate decline in home prices just on that math alone. Forget about some of the other things that we're talking about here. And if we get some of the shoes to drop that you talked about and layoffs really get going, you kind of get this vicious cycle that begins to build on itself here. And we could end up with a pretty, I think, a moderate to a quite bad recession. And kind of where I'm going with all this is, at the end of the day, it doesn't really even matter what the policy intent is or why you take the path you take. I'm just looking at a lot of people right now who are listening to what the authorities are telling them about the jobs market, which is, hey, economy is strong, jobs are good, and they're not that freaked out yet about the markets for the reasons you talked about. They still believe the Fed's going to rescue them at some point. And so my fear is that a good chunk of society may be sort of sleepwalking into a really tough time next year. Now, hopefully it doesn't unfold the way that I think it will. But even if we get kind of a, 01 style, recession, that's still really bad. And anybody that we can kind of open their eyes to say, at least today might be a good time to start planning for what you might do if your company starts having a reduction in force. Just getting people to do the game planning now versus just waking up one day next, Q2 of next year, whatever, and being surprised that they got a pink slip waiting for them and then their lives are, turned upside down.
Yes, and I agree with that. And let me throw another messaging at you here. We had the midterms last week, and I'm going to try and say this in a nonpartisan way. The reelect rate in those midterms, now we don't quite know all the races yet, but we're pretty close, was one of the highest in American history. In the Senate, we had 34 Senate seats up for re-election. Only one seat turned over, only one, and that was the Pennsylvania seat, went from R to D. Now, we don't know Georgia yet, but the Democrat, Warnock, is running ahead of Herschel Walker, at least in the perception of who's going to win. And if he wins, it will only be one turnover. That'd be the lowest ever. And if you look in the House, the Republicans might have picked up 8 seats, maybe 10. So 435 seats, something like 420 of them got reelected. Safest job in America in 2022 was a politician running for reelection. They all won. It's basically what happened. What is the message? What is the message that both sides seem to be taking from that? Oh, everything's fine. Double down on what we're doing. Double down, on what we're doing. We don't have to change course on anything. The Democrats are saying we're supposed to get wiped out. We weren't wiped out. So we're just going to continue. We're going to have Inflation Reduction Act Volume 2 next, and then Volume 3. And the Republicans are saying, see, we picked up the House, so therefore what we are exposing, double down on that as well, too. So it's like nothing has been learned. And so you're right. We're going to next year, that it'll be a cold slap in the face, and both sides, and everybody's going to have to learn status quo can't hold. Because otherwise the status quo is going to be tough markets, more inflation, more pain. And right now it has been that, and there has been a lot of pain, and yet we're all waiting for this to magically end. And so we'll see whether or not it does, or we'll see what breaks or how the Fed goes. But right now, it's all about one guy. It's all about Jay Powell. And, if he comes out and says he had to change, could you imagine what the markets would do if he said he'd come out and he had to change a heart? And I agree with Lael Brainerd, what the markets would do at that point. So it's incredible how we're just on one guy and one guy's belief right now.
And I've lamented this long on this channel, which is we really can't be investors. We haven't been able to be investors for the longest time in this environment because we're forced to be speculators on what the Fed or its chair is going to do next, because that's just what drives the price action, sadly.
And what else has been a problem with that? When you ask me, maybe I'll jump ahead. I know you're going to ask me about what should investors do, and I'll give you one idea. I've been in our, back in 2009, 2010, I argued stock picking is a dead art form, in that everybody is just buying indexes. Buy the S&P. If you think energy is going to do well, buy XLE, which is the energy ETF. And and you could go on and on and on with examples like that. And that worked. That macro kind of picking idea worked. I think in this next environment, we're going to go back. It's going to be the era of Peter Lynch again.
Yeah.
We're going to go back to stock picking. Oh, I think that energy is going to go up, and that energy is a good place to be. Yeah, I agree. I agree. I think energy is going to be a good place to be for the next couple of years, but it may not be just by XLE. It might be going through every balance sheet and every income statement and every management outlook and picking selected companies. And that's something we haven't had to do for 15 years. And that is a skill set that is kind of atrophied for a lot of investors and certainly a lot of professional
A lot of
managers.
professionals. Yeah.
Yeah. And they're going to have to, go through the whole thing of like when you start working out again and you're sore and you can't get up in the morning and before they could, get back into shape for stock picking all over again. And I think that that's real. And, it's amazing when I say that to people, they get very defensive. Oh, no, you're wrong on that, because they want it to be when the Fed signals buy S&P, buy SPY and watch everything go up and get rich. And that, like I said, they're not wrong, because that's what has worked.
Because it's worked. Yeah.
Yeah. But going forward from here, I think it's going to be more of an alpha driven market, to use the fancy word, of stock picking. And it's going to be about, in that era of no longer have cheap energy, no longer have cheap goods, no longer have cheap labor. We're going to have to figure out which companies can survive in that environment better than other companies. And so, yes, if we need infrastructure rebuilding, it's not going to be judged just by the industrial index and you're good. It's going to be which industrial companies are we going to buy? And that's a question that investors have not had to face for a long time.
That is a great point to hammer on. I love the way that you described it there too. And as at Wealthion, we constantly remind people, especially given the environment we're in, it's so challenging, it's so uncertain. It's in a lot of ways, there are unique elements that we haven't been here before. And so the average person, we say, look, you really should work under an experienced professional financial advisor who takes all these macro issues that you and I were talking about into consideration, Jim, and has the experience to help you come up with a plan and to navigate this. Because for the average person, they just don't have the expertise or the time. But you're adding this additional factor in, which is, any financial advisor that started their career in the past decade hasn't really had to do true stock picking. The monkey with the dart approach has worked really well. It's been easy.
Or YOLOing into options that expire on Friday. That was an investment strategy, and it's still, people still think it is.
Yeah.
And so you're right. They haven't had to do it, and they're going to have to learn now.
So a requirement I just sort of want to add to my regular advice to people is really make sure that you're working with an advisor who has enough tenure, that they have enough years of their career having done this before when it mattered, so that they have the expertise to do it going forward. You're not relying on somebody to just try to figure it out on the fly, who hasn't had to exercise these muscles professionally.
I agree. I completely agree.
So are there, let me put it this way, in terms of, any particular assets that you are, recommending clients to your readers to take a look at here, feel free to mention any that you like, but one I've talked about of late on this program that I'd like your opinion on is bonds. Bonds are now providing an alternative after a long time of not doing that. And at least with like the long government sovereign bonds like the US Treasury, you've got the opportunity to one, get paid, a decent yield, at least compared to relative years, recent years. And you have the optionality value that if interest rates start coming down again for whatever reason, that you could actually have some big value gain. So curious what you think about bonds.
Yeah. So I'm good friends with Jim Grant of the Interest Rate Observer, and he likes to say it's nice to have interest rates to observe again.
It's so great. We had him on like 2 weeks ago. He didn't use that pearl, but I love how he turns a phrase.
Yeah. And but you're right. As far as investors go, if you look at short-term bonds, the 2-year Treasury note, even the 1-year bill, in interest rates in there, no credit risk. It's the credit of the United States. And trust me, if the US defaults, you got bigger problems than just that they defaulted. You're getting around 3.5% to 4%. Boy, that's where I think the inflation rate is going to settle out. So I can get a zero real without taking any risk at all. Short-term bonds are starting to become an interesting place to look at, especially like in the 2-year note.
Yeah.
Long-term bonds, the 10-year note, those types of interest rates. The thing you have to be careful of there is short-term rates are really tied to what the Fed decides to do. So if they're going to keep raising rates, they'll keep inching higher, but the maturities are so short, the price losses are going to be negligible compared to the yields you get. In the long end of the curve, that's where investors and punters in the bond market will operate. As long as the Fed keeps raising rates, they keep going higher in yield, or lower in price. Yield and price move opposite. But once you start to get wind that there's going to be a recession, there could be a huge rally in the long end of the curve. But you don't want to front run it, because the story all year has been people saying, oh, but there's going to be a recession and you got to be long bonds because then they're going to rally. And it turned out to be the worst total return year in 102 years, according to Bank of America.
It's been like a garbage disposal. It's just ground up the capital that's gone in so far. Yeah.
Right, exactly. And eventually, when you get that rally, it's not gonna help you. So I am sympathetic to the idea that there's a big rally coming in the long end of the curve. Just not so sure it's right now. And so I like, bonds on the very, very short end of the yield curve. The other thing that's been really a terrible place to have your money is international. And that's because in international, you're denominated in other currencies. And the dollar has been this tower of power. And you don't want to be holding investments in a weakening currency. And so it's been bad all year. I'm not ready. I know the dollar has had a huge reversal last week. I'm not ready to say that that's it. We've seen the peak in the dollar because currencies tend to do something like that. But if we do go to recession, I do think that internationally being denominated in something other than the dollar, and by the way, that would also include gold as well too, is going to really pay good dividends. Little early yet, but we're getting close to that. Maybe first quarter, second quarter, we might see that play come. So right now, I like short-term bonds. I'm looking for this idea of what happens if the economy turns south in a hurry. Long-term bonds is going to be a good place to be. And internationally, the dollar will go down. So you want to be denominated in a currency that will appreciate in value in an international type of fund. You don't have to take credit risk. You could buy an international government fund, that all developed countries, not emerging. You take credit risk with emerging, but they'll buy EU bonds, they'll buy British gilts, they'll buy French oats, they'll buy German bunds, those kind of things. They'll buy Japanese JGBs, maybe a little bit of those. Australia, New Zealand, Canada. Not Brazil, not India, nobody wants to touch Russia right now, but not any of those countries. So that's where I think you might find, from a macro perspective, some other types of investments. But like I said, from stocks, I think that there's going to be the inflation play, and the inflation play is the problem there is that it really is, you really got to be a stock picker to understand this. It's not going to be about just buy the industrials or buy the energy or buy manufacturing or sell technology or something like that, because that was the last 20 years. I just don't think it will be going forward.
Okay. And since you mentioned it, let me just ask about gold. What do you think will be the catalyst for gold there? Will it be the dollar sort of finally reversing? Because a lot of people will say, well, gold's really all about real rates. And, if Powell keeps hiking, and CPI is coming down, well, interest rates would be getting more real under that scenario, which some would say was gold unfriendly. So I'm just curious which you think will win out.
Yeah, the problem with real rates is, from what I've seen, the relationship between real rates and gold is essentially zero. It's not there. It really is a dollar play. As I mentioned earlier, we've so financialized gold that it's become another kind of currency. It shouldn't be, but it is. Because so many people are so worried about owning gold, on the New York Stock Exchange as a derivative, as a future, as an option, that it is susceptible to the same problems in the systemic financial problems that everything else is. So in that environment, as I mentioned, gold takes on the characteristics of a currency. Currencies have been devaluing against the dollar, and they've all been suffering this year. Gold has actually held up better than some of these currencies have as well. So if we get into a period of weak dollar in 2023, and I said international, gold fits that criteria as well too. It will benefit from the weak dollar story, just like it's been hurt this year from the strong dollar story.
Right.
What has been the strong dollar story this year? The strong dollar story has been, I think, a twofold thing. It has been one, that the uncertainty in the world, and that when the world gets very uncertain, what people outside the United States do is they say, I don't know what's going on. So the first thing I do is I put my money in dollars, and then I figure out what's going on. So you saw this in 2020, you saw this in 2008, you're seeing it now, that when the world gets uncertain, the dollar rallies because it's a safe haven bid is what it is. Two, we've been the most aggressive in raising rates, and we've got some of the highest interest rates in the developed world. So from an interest rate parity standpoint, the dollar has also not only been a good place to be from a safe haven standpoint, it's giving you a yield.
Right.
But next year, if we see a downturn in the economy, all of a sudden the dollar doesn't look like where I want to be, and their interest rates are going down. Maybe I want to be somewhere else, and you could see the wholesale flight out of the dollar. That'll benefit gold and some other things.
All right. Well, look, Jim, I have a lot more questions I'd love to ask you, but you have left it all in the field, my friend. 2 hours here. Thank you so much for being so generous with us with your time.
Thank you.
You're one of my favorite guys to interview, Jim, and I look forward to having you back on the program again soon to dig into even more of some of the questions I didn't ask, but also as some of the things you talked about begin to unfold. Would love to hear your audible calls on them. I got one last question for you, and that's just for folks that have really enjoyed listening to you in this interview, and they'd like to go follow you and your work. Where should they go?
Well, our website is biancoresearch.com. We offer a product for institutional investors, but you can ask for a free trial and see what we do behind the paywall. Otherwise, I am very active in social media at Bianco Research. Look for the blue check mark. Now, the reason I say that is there's a lot of scammers that copy me and copy a lot of other people in the financial space. Look for the one with the huge number of followings and the blue check mark. That's me, not one of the scammers. I will never, ever, ever ask you for money, which is what the scammers do under my name and likeness. It's becoming a problem. That's why I
appreciate you mentioning that. I've got a few too, and it's a real source of heartburn.
It is. It is that people are using my name and my likeness to rip people off, and I can't do anything about it. It's up to Elon and Twitter to fix it, and hopefully they will soon enough. So you can follow me on Twitter if you get to the right one. You can follow me. Otherwise, I'm on LinkedIn at Jim Bianco.
Okay, great. And Jim, we'll put up the URLs to your website and your Twitter handle, et cetera. When
it's
we
at
this,
Bianco Research. Spell it correctly. A lot of the scammers spell it incorrectly.
Yeah, we'll put up the correct spelling. Yeah.
Yeah.
All right.
Thank you.
Look, thanks so much. And for folks that are watching, just a reminder, as I said earlier, and always say, get a good financial advisor to help you navigate what's going on here. If you've got a great one, great, stick with them. They are literally worth their weight in gold, which this is going to get even more valuable going forward. But if you don't have one, or you'd like a second opinion of one who does, consider scheduling a free, absolutely no strings attached, no commitment, free consultation with the financial advisors that Wealthion endorses. They're the guys that come on this program with me every week. So if you want to set one of those up, just go to wealthion.com. Only takes you a couple seconds to set that up. Again, just super enjoyable. Thank you for giving us so much of your time and for just being such an overall great, mind, and also sharing as generously as you do.
I enjoyed it. Thank you.
All right. Thanks. And everybody else, thanks so much for watching.